Welcome back to the deep dive. I'm glad you're here because today we're doing something a little different. We aren't just skimming the surface of a topic, we are uh, putting on the heavy gear and going all the way to the bottom.
Right down to the bottom of the ocean of financial reporting.
It is deep, it is dark, but I hear there are some fascinating things down there.
There absolutely are.
I know, I know. As soon as I say financial reporting or, accounting standards, about half of you might be instinctively reaching for that skip button. Your thumb is hovering.
Hold on. Don't do it.
Don't touch that dial.
Please don't. Because today isn't really about numbers in a spreadsheet. It's about reality. You could even say it's about truth.
That is a big claim for an accounting deep dive. But let's unpack it. We are talking about Indian Accounting Standard 116, Ind AS 116.
A big one.
The topic is leases. And before you roll your eyes, I want you to think about a magic trick.
A magic trick. Okay, I'm listening.
Yes. For decades, companies pulled off the ultimate magic trick. They would have massive amounts of debt, huge liabilities, and they would just make them disappear.
Oof.
Poof. Gone. You'd walk past their headquarters, you'd see the airplanes, the fleets of trucks, the shiny office towers, but then you look at the balance sheet and...
Nothing. It's not there. That was the whole era of off-balance sheet financing.
it was an illusion.
It absolutely was. It allowed companies to look much healthier, much less leveraged than they actually were, simply by calling a contract a rental or a service agreement instead of what it really was.
And then AS 116 was the spell breaker.
It was. It was a massive shift in how businesses have to recognize their own reality. The standard essentially came in and said, look, we don't care what you call it. We care about what it is.
It's all about visibility.
Exactly. It's about bringing those hidden liabilities out of the shadows and onto the books so that investors, stakeholders, and even the companies themselves can actually see the leverage they're carrying.
It's like turning on the lights in a dark room and realizing, oh, wow, there's a lot of furniture in here I didn't know about, and I owe money on all of it.
That's a perfect analogy. And the core philosophy here, and you'll hear me come back to this again and again, is substance over form.
Substance over form.
It doesn't matter if the legal title of the document is service agreement or supply contract. If the substance of that deal is that you control an asset and you are paying for that control, the accounting standards say that is a lease and you need to account for it.
So our mission today is to decode this. We have our source material here, specifically Unit 8, Indian Accounting Standard 116. We aren't just going to read the text. We're going to walk through the rigorous logic, the flowcharts, and the decision trees that determine if a lease even exists.
And it really is a matrix, a complex decision tree involving identified assets, the right to control, substitution rights, and then once you're sort of in the club, you have to understand the critical timeline concepts like inception versus commencement.
Okay, let's jump right in. Section 1, the scope. Who is invited to this party?
Well, the short answer is almost everyone.
It's a popular club.
A very popular club. The general rule for Ind AS 116 is that it applies to all leases, and it casts a very, very wide net. It even includes leases of right-of-use assets in a sublease.
Okay, let's pause on that for a second. A sublease.
Right. So let's say I lease a massive warehouse from a landlord. That's a lease, straightforward. But then I turn around and I lease one specific bay of that warehouse to you.
Okay.
That transaction, the one between me and you, is also caught in this web.
Yeah.
The standard doesn't care that I don't technically own the building. I control the right of use, and I'm passing that control to you. So Ind AS 116 applies all the way down the chain.
Got it. So the default setting is you're in. If you are renting something, you should assume Ind AS 116 applies. But like any good rule, there are exceptions. There are the VIPs who have their own private clubs.
Exactly.
They don't need to follow Ind AS 116. Who are they?
These are the specific exclusions or carve-outs. And it's really important to understand why they're excluded, because it tells you a lot about how accounting thinks.
Okay.
The first big group involves the extractive industries.
Extractive. Sounds intense.
It is. We're talking about leases to explore for or use minerals, oil, natural gas, and similar non-regenerative resources.
So if I'm a big oil company and I lease attractive land in, say, Rajasthan to drill for oil, that's not an Ind AS 116 lease.
Correct. That would fall under a different standard, Ind AS 106, which is exploration for and evaluation of mineral resources.
Why the special treatment, though? Why not just call it a land lease?
You have to think about the economics of it. When you lease an office, you know the office is there. You know it works. When you lease land to drill for oil, You are taking a massive, massive speculative risk.
You might find nothing.
You might find absolutely nothing. The value isn't in the land itself, but in what might be under it. The economics of exploration are so specific and so risky that they really require their own accounting standard to deal with that uncertainty. And AS-116 is designed for assets where the utility is known and predictable.
That makes perfect sense. It's a different game, so it gets a different rule book. What about the farmers? I see biological assets on the list of exclusions.
That's the second one. Leases of biological assets held by a lessee. So if you are leasing, say, a herd of dairy cows or an orchard of apple trees or even vines in a vineyard,
Living things.
anything that's living, that falls under Ind AS 41, agriculture.
I have to ask, why can't we just treat a cow like a truck? I lease the truck, I lease the cow, I pay monthly. What's the fundamental difference?
The difference is a concept called biological transformation.
That sounds like a sci-fi movie.
It does, doesn't it? But it just means that living things, they grow, they degenerate, they die, and most importantly, they procreate. A truck depreciates in a straight line, more or less. It doesn't wake up one morning and have a baby truck.
I love that idea. That would solve so many supply chain issues. Mommy, where do scooters come from?
Exactly. But a cow does have a baby cow. An apple tree grows new apples. The value of the asset is constantly changing in a very nonlinear way. A standard lease model, which creates a static right-of-use asset and amortizes it, it just can't capture the dynamic economics of a living, growing thing. So Ind AS 41 handles that complexity.
Okay, so minerals are out because they are risky and hidden. Living things are out because they grow and multiply. What's the third one?
Service concession arrangements. This is typically public service infrastructure. Think of a private company building a toll road or a bridge or a hospital for the government.
We see these a lot. Public-private partnerships or PPPs.
That's the one. Now, on the surface, it kind of looks like a lease, right? The company builds the road and operates it for 30 years. But usually, the government still controls the important stuff. They control the price, the toll, they set the standards. They decide who can use it, which is the public. So the private company doesn't really control the asset in the way a lessee controls a car.
They're more like a service provider.
Precisely. They are providing a service to the government. Therefore, these deals fall under Ind AS 115, which deals with revenue from contracts with customers, not leases.
Got it. So unless you're drilling for oil, milking a leased cow, or building a toll road for the state, you really need to pay attention to Ind AS 116.
That's it. And if you are in the scope, the very first step, the absolute foundation, is the core test. You cannot have a lease unless you have an identified asset.
This sounds so obvious, doesn't it? I'm leasing a car. The car is the asset. But in the world of complex corporate contracts, I'm guessing it's not always that simple.
No, it's not. And this is the anchor of the whole standard. An asset can be identified in two ways, explicitly or implicitly.
Okay, explicitly seems easy. That's when the contract says, you are leasing the Caterpillar excavator, serial number 12345.
Correct. It is named in the contract. There's no ambiguity. But where Ind AS 116 gets interesting, and where the auditors get excited, is with the concept of an implicitly identified asset.
Implicitly, so this suggests it's not actually written down anywhere.
Exactly. The contract doesn't name the specific asset, but the supplier has no practical choice but to use a specific asset to fulfill the deal.
Let's use the example from our source material, the rolling stock case. I love this one because it feels like a detective story.
It is a classic example.
Yeah.
So let's set the scene. You have customer XYZ. They're a mining company or a heavy manufacturer. They need to transport materials for their production process.
Yuck.
They enter into a 10-year contract with supplier ABC. The contract simply says supplier ABC will transport our goods using rolling stock, which is just industry speak for train cars.
And here's the catch. The contract does not list the serial numbers of the train cars. It just says, transport our stuff. So on the surface, this looks like a service contract. I pay you, you move my goods. No specific asset named.
And if you stopped reading right there, you might think, okay, no identified asset, therefore no lease. This is just a logistics expense. But Ind AS 116 demands you look at the reality.
Okay, what's the reality?
The source tells us that supplier ABC only owns one set of rolling stock that is suitable for XYZ's specific materials. And what's more, these train cars were designed specifically for customer XYZ.
So maybe the ore they're hauling is corrosive or it needs a special shape of container or something.
Something like that. They literally cannot be used by anyone else, and the supplier has no other trains they could use instead.
So even though the contract plays it cool and doesn't name the trains, the supplier is handcuffed. They must use those specific trains to do the job.
And that is the Sherlock Holmes moment, as you put it. We deduce that the asset is implicitly identified because the supplier has no practical alternative. Therefore, the first hurdle of Ind AS 116 is met. We have an identified asset.
That is fascinating. It really prevents companies from being deliberately vague in a contract just to avoid lease accounting. You can't just delete the serial numbers and say it's a service.
Exactly. Substance over form, every time.
Oh, wait, there's a nuance here about physically distinct assets. I found this part a little confusing.
It can be.
Yeah.
An identified asset has to be physically distinct. So if I lease an entire floor of a building that's physically distinct, I can point to it, I can lock the doors, it has walls.
Simple enough, but what if I lease capacity? Like, I want to rent 20% of the capacity of your oil pipeline.
Ah, that's where it gets tricky. A capacity portion, like 20% of a pipeline, is generally not an identified asset.
But why not? I'm paying for it. I'm using it.
Think about the physics of a pipeline. You pour your oil in at one end, it mixes with everyone else's oil. When you take oil out at the other end, you aren't getting the exact same molecules you put in.
I'm getting an equivalent amount.
Exactly. You cannot point to a specific section of that physical pipe and say, that 20% right there, that's mine.
So 20% of a pipeline is just a service.
In most cases, yes.
It
The
goes
service of
ahead.
transportation.
Yeah.
Unless, and here's the exception, unless the contract gives you substantially all of the capacity.
So like 99% of it.
Pretty much. If you contract for 99% of the pipeline's volume, you effectively have the whole pipe. The standard says in that case, it is an identified asset because you're consuming the entire economic utility of that physical thing. But generally, mere capacity portions don't qualify.
Okay, so we've established we have an asset. We found the train cars. We know which ones they are. But the supplier has one more trick up their sleeve. The get-out-of-jail-free card.
The substantive substitution.
Oh, yeah.
This is a critical concept in Section 3 of our discussion today.
Right.
Even if there is an identified asset, Ind AS 116 says it is not a lease if the supplier can swap it out at will.
Swap it out at will. That sounds like the supplier saying, sure, you're using car A today, but I might take it back and give you car B tomorrow just because I feel like it.
That's the idea. And if the supplier has that right, then the customer doesn't really control the asset, do they?
No, the supplier does.
The supplier controls the fleet, the customer just gets a ride. So if there is a substantive substitution, right, it's not a lease, it's a service.
But the word substantive is doing a lot of heavy lifting there. It can't just be any right.
It is the most important word in that phrase. It's not enough for the contract to just say, supplier reserves the right to substitute. You know, lawyers love to put that clause in everything.
Oh, of course.
That's just words on paper. To be substantive, 2 criteria must be met.
Okay, let's break them down.
Criterion 1, the practical ability. The supplier must have the actual practical ability to substitute the asset at any time without asking your permission.
So, going back to our trains. If the train cars are in India and the only replacement cars are in a depot in Canada, they don't have the practical ability.
Correct. Physical location matters. Or if the machine is bolted to your factory floor and it would take a crane and a team of engineers 2 weeks to move it. The supplier might have the legal right to move it, but they don't have the practical ability to do it at any time.
Okay, that's the physical hurdle. What's the second one?
The second criterion is even more important: economic benefit. The supplier must benefit economically from substituting the asset,
Meaning it has to put money in their pocket to switch the cars.
or it has to save them significant money. The standard requires that the economic benefit of substituting the asset must exceed the cost of doing so.
So we have to look at the supplier's internal math
You do. Think about it. Why does a business do anything?
to make money.
To make money. If swapping the asset involves high logistics costs, repainting, reconfiguring software, or disrupting other customers, the cost is high. If the benefits, say, optimizing their fleet slightly, is low, then they wouldn't do it. No rational business would burn money just to exercise a clause in a contract.
So if the cost outweighs the benefit, the right is not substantive, it's a bluff.
It's a phantom right, and for accounting purposes, we ignore phantom rights.
Now, this creates a problem for me as the customer. I'm sitting here trying to figure out if I have a lease. I don't get to see the supplier's internal profit and loss statement. I don't know their logistics costs. How am I supposed to prove this?
That is a fantastic question, and the standard setters anticipated this exact problem. This is a key insight from the source material regarding the burden of proof.
Who has to prove it?
The standard actually protects the customer here.
How so?
It says, if the customer cannot readily determine whether the supplier has a substantive substitution right, the customer must presume that the right is not substantive.
Oh, I like that. That is a massive thumb on the scale for the customer.
It is. It essentially says, customers, you aren't expected to be private investigators. You don't need to hire a team to find out your supplier's internal costs. If the substitution right isn't obvious and easy to see, you just assume it doesn't exist.
You assume you have the asset.
You assume it's a lease.
That really closes the loophole. It prevents suppliers from using vague substitution clauses just to keep things off the balance sheet.
Precisely. Unless the supplier can prove, look, I have a pool of identical cars and I swap them every Tuesday to manage mileage, you book the lease.
Okay, so let's recap where we are. We have an identified asset. We've done our Sherlock Holmes deduction. We've confirmed nobody can swap it out because the substitution right isn't substantive. Now we get to the heart of the matter. Section 4, the right to control.
This is the core test. You can have an asset, but if you don't control it, you don't have a lease. Under Ind AS 116, control is a dual test. You need two things simultaneously throughout the entire period of use.
Hit me with them.
Number one, the right to obtain substantially all economic benefits from the use of the asset.
And number 2.
Number two, the right to direct the use of the asset.
Okay, let's unpack economic benefits first. This feels pretty straightforward. If I lease a machine, I get the widgets it produces.
Yes, it's about the output, whether that's physical widgets or the cash flow generated by an office, or the value of transporting goods. It includes the primary products and any byproducts as well.
And substantially all usually means what? Is there a hard number, like 90%?
The standard doesn't give a hard percentage, but in practice, yes, typically 90% or more is the benchmark that people use.
Yeah.
If I lease a solar farm and I get 95% of the electricity it generates, I have substantially all the benefits.
Okay, but what if the contract says the supplier takes a cut? Say, I lease a retail store in a mall, but the landlord takes 5% of my gross sales as turnover rent. Do I still have the benefits?
Yes, you do. The cash flow you generate from using the store is yours. That rent payment, even if it's variable, is just the cost of the lease. It's an outflow, but the benefit of the asset, which is making the sales, that flows to you.
Okay.
Now, if the contract said the landlord keeps 50% of the inventory you store here, that might be different. But standard revenue share rent doesn't usually fail this test.
Got it. Now, the second limb, this is the one that trips people up. Directing the use?
How and for what purpose?
It sounds like a philosophical question.
It is a single concept.
Yeah.
You don't assess how separately from for what purpose. It's about who makes the decisions that most affect the economic benefits you get from the asset.
So who is the boss of the asset?
That's a great way to put it. We look for the key decision-making rights. Who decides what the asset produces? Who decides when it operates? Who decides where it goes?
Let's go back to the truck example, because this is where the distinction between operating and directing is just so crucial.
Yes. Let's say you hire a logistics company. They provide the truck. They provide the driver. They pay for the fuel. You never touch the steering wheel.
Okay, but I tell them, pick up goods at point A on Monday at 8 a.m. and deliver them to point B on Tuesday.
In that scenario, you are directing the use. You are deciding the where and the when. You are determining the output of that truck for that period.
But I'm not driving. The supplier's employee is driving the truck.
It doesn't matter. This is the concept of outsourcing the operations. The physical act of turning the steering wheel or pushing the start button on the machine is less important than the decision of where to drive or what to make.
So I'm the brain. The driver is just the hands.
You're the brain. That's a great distinction. Operation does not equal control. I can be the puppet master without physically pulling the strings myself.
Right.
Exactly. However, we have to watch out for protective rights. This is the counterargument the supplier might make.
Protective rights.
Yes, the supplier might say, okay, you can drive the car anywhere you want, but you cannot drive it off a cliff, you cannot take it into a war zone, and you can't drive more than 500 miles a day.
That seems fair. I mean, I shouldn't be driving their car off a cliff.
Generally good advice for life and accounting. But legally, those are what we call protective rights. They exist to protect the supplier's investment in their asset. They define the scope of your rights.
So does that mean the supplier is directing the use? Don't drive off a cliff is a direction, isn't it?
No. Protective rights do not negate the customer's control. They just set the boundaries of the sandbox. Inside that sandbox, you can build whatever castle you want.
As long as you don't throw sand in the supplier's eyes.
Exactly. So having those kinds of restrictions doesn't mean you don't have a lease.
Okay, that clears it up. So let's bring it all together. We have an asset. We know nobody can swap it out. We know we get the benefits, and we call the shots on how and for what purpose. So congratulations, we have a lease.
We have identified a lease. We've crossed the threshold. But now we move into Section 5. This is the now what phase. This is where the accounting rubber hits the road. We need to talk about execution and timing.
And this is where the terminology gets very, very specific.
Yeah.
I have two dates that sound identical in plain English, but are totally different in accounting speak. Inception and commencement.
This is a vital distinction in AS 116. If you mix these two up, your financial statements will be wrong. It's that simple.
Okay, let's start with inception. This is the handshake date, right?
Correct. The inception date is the earlier of two dates. The date of the lease agreement itself, or the date of commitment by both parties to the principal terms.
So the day we signed the paper, or even the day we shook hands and said, it's a deal, even if the lawyers are still typing up the final clauses.
That's right. And why does inception matter? Because this is when you identify the lease. This is the moment you run the test we just spent all this time talking about. Is there an asset? Is there control? You figure all that out at inception.
Okay, so let's say I sign a deal on January 1st to lease a new headquarters. But the building is still being built.
Yeah.
It's just steel beams and concrete. I don't get the keys until March 1st.
That brings us to the commencement date. This is the keys date. The standard defines it as the date on which the lessor makes the underlying asset available for use by the lessee. March 1st in your example. And this date is critical because this is when the measurement clock starts ticking. You start recognizing the right of use asset and the lease liability on your balance sheet on the commencement date. You start depreciating the asset and accruing interest on the liability from this date.
So inception is for asking what is it, and commencement is for asking what is it worth and when do we book it?
Precisely. And this gap can be significant. If you sign a lease for a big retail store in a mall that's still under construction, inception might be today, but commencement might be a full year from now.
So what do I do for that year? Do I just ignore
You don't ignore it. You might have some disclosure requirements because you have a contractual commitment, but you don't put that big liability number on the balance sheet until you actually get the keys.
That is a huge distinction. I can see how companies might trip up there. They might think, oh, we signed it, put it on the books.
Right, but no, you wait for the keys, or the reverse can happen. We have the keys, but we haven't signed the final copy yet because the lawyers are arguing about font sizes.
Doesn't matter.
Doesn't matter. If you have the keys and the deal is agreed in substance, you have commenced. The reality of having the asset is what triggers the accounting.
Now, speaking of measurement, once we have commenced, we have to figure out the lease term. And again, it's not as simple as just read the date on the last page of the contract.
No, it's never that simple, is it? The lease term includes the non-cancelable period, plus any periods covered by an option to extend the lease, if the lessee is reasonably certain to exercise that option.
Reasonably certain, there's that judgment call again. Accounting is full of them.
It really is. Let's take a restaurant example.
Yeah.
You lease an empty space, a shell. The initial lease is for 5 years, with an option to extend for another 5.
Okay.
But you spend $2 million fitting out the interior. You put in custom kitchens, marble floors, expensive signage. That's a huge location-specific investment.
I am not walking away from that investment after only 5 years. I haven't even earned it back yet.
Exactly. You are reasonably certain to extend. So your lease term for accounting purposes isn't 5 years, it's 10 years.
And that changes the liability number on the balance sheet drastically.
It's easily double it.
Which goes right back to your point about transparency. The old way, I could say, it's a 5-year lease and kind of hide the reality of that 5-year extension. The new way says, come on, look at those marble floors. You're staying. Book the 10 years.
That's it. It forces the company to admit its true economic intent through the numbers on the page.
Now let's zoom out a bit. We are discussing Indian accounting standards. This didn't just happen overnight. Section 6, the transition.
No, it was a major rollout. For Indian entities, the mandatory application began for annual reporting periods beginning on or after April 1st, 2019.
April 1st, the financial new year in India.
Right, and moving from the old standard, which was Ind AS 17, to the new Ind AS 116 was a massive undertaking. I mean, imagine a telecom company with leases for thousands of cell towers, or a big retailer with 500 stores.
It sounds like a paperwork nightmare.
A total nightmare. So The standard provided a transition exemption, or transition approach. It allowed entities to use what are called practical expedients.
What does that mean in plain English?
It means shortcuts. For example, if you had already determined something was a lease under the old, less stringent standard, you didn't necessarily have to reassess it under the new, more complex definition on the transition date.
So you could just carry it over.
You could just carry over the classification with some adjustments. This saved a lot of administrative headache. You didn't have to reread and reanalyze 10,000 contracts on day one.
Now, a big question for our international listeners or anyone dealing with global companies, Ind AS 116 looks a lot like IFRS 16, which is the global standard used in Europe and many other places. Is it just a copy-paste job?
It is substantially converged.
Yeah.
I mean, Ind AS 116 is based on IFRS 16. If you know one, you know 99% of the other. However, it is not a blind copy-paste. There are what we call carve-outs.
Carve-outs, I like that, Carm. It sounds like sculpting. So what did India carve out?
These are specific deviations that are listed in Appendix 1 of the standard. They're designed to suit the Indian economic environment or to align better with other Indian standards. For instance, there could be differences in how certain fair value measurements are handled compared to the international standard.
So context matters. You can't just buy a textbook on IFRS 16 in London and assume it applies 100% to a company listed in Mumbai.
You would be mostly right, but that small percentage of difference could get you in trouble with the regulators. You absolutely have to check the Indian-specific appendix.
This has been quite the journey. We started with the big picture, is it a lease? By looking for the asset and the control.
We tried to dodge it with substitution rights, but the burden of proof stopped us.
Then we defined control through benefits and direction. And finally, we pinned down the when with inception and commencement.
It really is a comprehensive framework. It moves away from check-the-box compliance to tell me the real story of the asset.
And that leads us to our final takeaway. The standard really forces companies to look at the reality of their contracts, not just the title on the page. It captures implicit assets and rights that were previously invisible.
It creates a faithful representation of the financial position. If a company relies heavily on leased airplanes or leased cell towers or leased retail stores, that is a real liability. It's real leverage. And AS 116 ensures that liability sits right there on the balance sheet, right next to the bank loans.
Before we go, I want to leave you, our listener, with a provocative thought. We mentioned briefly in the text something called the portfolio approach.
Yes, that's applying the standard to a portfolio of leases with similar characteristics rather than doing it one by one.
Right, for efficiency. You know, I have 500 company cars. Let's just treat them as one big blob. But think about this. If you are a company with thousands of leases and you lump them all into a portfolio, how much imprecision are you accepting for the sake of that efficiency?
That is a very valid and very important question.
Does the convenience of the portfolio approach mask the unique risks of individual assets? I mean, if the market crashes in one city but it booms in another, the average of the portfolio might look perfectly fine, while underneath you have a festering problem in one part of the business.
Averaging out your assumptions usually works.
Yeah.
Until it doesn't. Until the correlation you assumed breaks down. That is a risk that smart analysts should definitely look out for.
Exactly. So for our listeners, next time you are at your desk, pick up a contract, any contract, a printer rental, a cloud server agreement, a fleet of delivery bikes, and ask yourself, who actually directs the use of this? Who is the brain? You might find a hidden lease sitting right under your nose.
And if you do, remember, substance over form.
Thanks for diving deep with us today. We'll see you on the next one.